Hi, today we're going to speak about different types of credit on your credit report. It is very important to know which types of credit impact your score positively, negatively, and ones that have no impact as well. So today we're going to review a sample credit report. This account has borrower, which means there's only one borrower on this actual account. So this is a mortgage account with residential home funding that was taken out in July of 2016 and last reported in October of 2017. So if you look at this top number, that's when the account was opened and when the last payment was made and when this report was actually pulled. So the initial mortgage on this account falls under account type, high credit limit, which is $315,000. Because this person's made payment on time for 1 year and 3 months, the balance is now $309,237. If you look at this number next to where you'll see this minimum monthly payment, which does include taxes and insurance, is 360 months. So that means that it's a 30-year mortgage. Now we don't know whether it's a fixed rate or an adjustable rate, we just know that it's a 360-month loan. Now if you scroll over, you'll see under past due if any balance is currently due or late. And then next to that will show how many months the payment has been made. So if this said 10, that would be 10 months of payments. Now let's scroll down to second mortgage, which is also under the borrower's name, which is an FHA real estate loan taken out in August 2016. And the original balance was $213,141. And then the current balance followed by the loan term. Scroll down there, you'll see a car payment, GM Financial, which was taken out in December of 15, and the current balance is $63,379. Now, these three types of loans do not help your credit score. They can only hurt your credit score. So by having these types of loans, the only way it will impact your credit is if you make your payment late, okay? Now next, this borrower has a Chase credit card with a balance of $25,796. And there was a late payment in November of 2014. So this shows that it was 30 days late over 3 years ago at this point. Now the maximum limit is $26,000 and the minimum payment shows below. There are two open lending club loans, which are installment loans, which also don't impact your credit score in a positive or negative way unless you miss a payment, okay? So going back to the Chase credit card, because this balance is very close to the actual limit, that's bringing down the credit score of this person every single month because of the high utilization. Now if you scroll down more on here, you'll see TD Bank check credit or line of credit, which is also a high balance to limit ratio. That's bringing the score down because it is a variable line of credit. So understand the difference between a credit card or a line of credit opposed to an installment loan where you have a set payment. Banks want you to have credit cards so you can understand budgeting and pay a different payment every month. When you have a set payment over a certain time frame, like 360 months or 60 months or 36 months, these types of loans are set every month and you're able to properly budget. But if you're able to change your credit with a credit card because of the balance fluctuating and the payment fluctuating, banks will give you typically higher credit scores for being able to manage that. So if we go ahead and scroll down here, keep going down to the next page, showing the full page. This right here will show credit closed, meaning if you had any old credit cards or any type of accounts or installments or student loans paid off, it will show you that the account's closed or the account's paid, okay? So those are very beneficial in checking someone's credit history. Now if you scroll all the way down to the bottom, which we're going to stop at the bottom of this page, it will show, that's good right there, it would show somewhere down here whether you have open collections or judgments or tax liens on this report, okay? Because this client doesn't have any of those, you won't be able to see those there. So you always want to make sure it's important to read your credit report accurately, and the best thing is getting what's called a tri-merge credit report. Tri-merge credit report is comprised of an Equifax, TransUnion, and Equifax, TransUnion, and Experian credit report. It's hard to do this without practicing in advance. And getting those 3 scores will give you, say, a 700, a 720, and a 730 credit score. For lending purposes, we use the middle score. So as soon as you get your tri-merge credit report, look at the middle score, and that's what a bank uses to determine your credit worthiness. So we hope you learned a little bit about credit reports and scores. Make sure you pay your bills on time. Make sure you keep your credit card balances at 20% of what your allowance is. Make sure you have 1 or 2 installment loans, and make sure, again, you pay everything on time. If you have any medical collections or judgments, let's work together to help get those cleared up. We'll help you get into payment plans, and we'll help get you on your way to home ownership. So if you need anything, contact us. Remember, at Residential Home Funding, we put the fun in funding.